And switching focus to business news then, economic red flags are rising in Pakistan as the current account deficit widens by 256% in just 4 months. The main reason for this is imports are rising much faster than exports, and even though export earnings have improved slightly, they have not kept up with the pace of incoming goods. As a result of which, the overall trade gap has widened, and October saw the return of a monthly deficit after a brief surplus in the month of September. The trend even signals pressure on the rupee and Pakistan's foreign exchange reserves. The import surge is happening at a time when Pakistan's debt load is already becoming difficult to manage. Public debt has climbed sharply over the past year, that's driven by weak economic growth and the need for constant external financing. Rising share of government revenue now goes towards interest payments. That has left less room for development and public services. To contain these pressures, Pakistan's central bank has even introduced stricter rules on the use of US dollars. Cash dollar access has been tightened, and banks must now route most foreign currency transactions through digital channels. Meanwhile, the World Bank has delivered a tough assessment of Pakistan's export economy, warning that the country's weak export performance is not a short-term issue but the result of decades of inconsistent policies, high energy costs and outdated trade agreements. The country's manufacturers continue to struggle with expensive power, slow tax refunds and bureaucratic hurdles, all of which make it harder to compete globally. The bank even says that Pakistan needs a more flexible exchange rate, lower business costs and long-delayed economic reforms, or it risks facing repeated external crisis.